It's Brian Preston, the money guy.
Here's the third thing that you can do before year end. And this one breaks my heart a little bit because I believe so often people just gloss through it. And it's don't ignore open enrollment. When you're at your job and you get that HR email that says, hey, open enrollment's opened up, you got to go in and make your selections. Far too many of my friends and peers just go default to, oh yeah, here's what I did last year. Whatever I did last year, I'm just do that again. And they don't recognize how much of a benefit the benefits at work can be to your overall financial plan.
Well, I mean, it's back to we're busy year end. I mean, we got a lot of holidays that get stacked in between Thanksgiving, between Christmas. So I think a lot of people, because you're getting pulled in all these directions, you're like, oh, heck, I see this disclosure from my employer. I'll just
get through it.
I'll just get through it. But you are overlooking a very powerful thing. Because remember, we've done so many shows on health savings accounts. And I love health savings accounts. You do have to have a high deductible health plan, which means that you are going to carry a lot of the cost of what your health care is through that health savings account. Maybe that's not the perfect thing for you. Maybe you plan on having a child in this upcoming year. Maybe you ought to look really extra hard. Should I do the PPO version where they're going to cover a lot more of my medical expenses because I know I'm going to be really leaning hard on those benefits next year? Pay attention to those life decisions because there's a reason they offer open enrollment. It's your chance to basically predict what's going to happen in the next year and maximize the opportunity.
Yeah, so let's talk about, and you already alluded to one of them, what are some of the biggest open enrollment decisions? You've already said the first one. Most often it's health insurance. And don't just assume that what you did last year is what you should do this year. Maybe you're someone who's entering into having a new baby in the next year, and that's going to change what your healthcare needs look like. And when that happens, you might want to adjust. Okay, I don't need to do the high deductible plan. I want to go for the Cadillac plan or whatever your circumstance may be. Maybe you have kids that are aging out and flying out of the nest, and so you need to go from family coverage down to individual coverage or individual and spouse coverage. Make sure you understand the different options that are available to you going into the next year.
Well, think about dental and vision. Something always, I think you got to pay attention. Anybody who's got kids of a certain age, you know what I'm talking about here. Orthodontics. It seems like we strap braces on every kid that comes out these days.
It is like right on the cusp.
So I want to encourage you, go read, if you have dental insurance, go make sure you go read the fine print because some of these will require you to be part of the dental plan for like a year before you qualify for orthodontics. So just make sure you go read the fine print because vision, dental, these are not a kind of something that's in everybody's health insurance. So if you do have these options, you ought to at least make sure, am I going to elect this year or am I going to opt out of it this year? Pay attention to your life situation, pay attention to what they're offering, and try to figure out where the intersection is.
And look, we always talk about health savings accounts. They're a fantastic option for folks who are eligible to do that. But don't forget, maybe if you're not someone who has a health savings account, do you have a flexible spending account available through your open enrollment, available through your health insurance? Or do you have other types of accounts like a dependent care flexible spending account that perhaps you could be taking advantage of?
Yeah, you don't get to typically do a flexible spending account and a health savings account at the same time, except for, remember, those dependent care benefits, you can have both a high deductible HSA as well as the dependent care part of the FSA. They do work together. That's one of those special options that they strap in there. And it is important because, look, childcare is expensive. I mean, especially in this inflationary period, because you know that price is going up just like everything else is. See if there's a benefit, because not only do you get a tax deduction on what is getting withheld out of your paycheck and then getting paid directly, you're saving the Medicare, you're saving the Social Security. There's a lot of benefits to both you and the employer for maximizing this opportunity.
And then, Brian, do you want to talk a little bit about, one of the big differences between flexible spending accounts and health savings accounts is that HSAs can carry over year over year. Well, if you're someone who's been funding a flexible spending account throughout this year, but you haven't burned through those expenses, this is the time of year where you may want to use those dollars so that you don't lose those dollars.
Yeah, that's why a lot of people with flexible spending accounts will typically go do all their vision appointments. They're like, oh man, I still have extra money. So I guess instead of just getting reading glasses, I'm also going to go buy some new Ray-Bans, and all the because you see it. I mean, people will do that where they're loading it up because it's use it or lose it. Pay attention to those numbers to make sure you don't leave anything on the table. It's different though with HRA FSAs and HSAs because those do get to roll over. It is one of those things where, because remember, with HSAs, when we do those deep dives on that, there's only 4% of the population that's actually taking advantage of all three tax advantages. It's not only, because most people do the tax deduction, but the fact of letting it grow tax deferred and the fact that you can pull it out tax free on all the growth does require you to invest some of that money for the long term. So pay attention to that part of it as well.
Another thing that you should pay attention to when you're working through your open enrollment decision making are the insurances available like disability and life insurance. A lot of employers will offer employer-sponsored life insurance. Perhaps there's some free portion, there's some portion that you can opt into. It makes sense to understand how that works and if that does make sense for your situation.
And then always pay attention to if you're in these high hat deferred comp, anything, if you're a high income individual, you're in that tippity top tax bracket right now. But especially if you're one of these people that's retiring in your 50s or 60s, you're going to go from the tippity top tax bracket probably to a lower tax bracket if all of a sudden you retire and you're 20 plus years from even being required to pull out of your retirement account. Why not defer some of that income through your employer plan so that it serves as that bridge account? Because a lot of people are nervous. How am I going to pay for health care? How am I going to pay for all these things between 55 to 65? A deferred comp plan could really be a powerful bridge to get you through that. And if you're an executive level type person, you want to look at that. But look, there's risk. This is why this is probably a graduate to the next level, an abundance cycle where you hire financial advisors, because look, deferred comps are on the company's balance sheet, meaning that if there's any type of peril for the company financially, you would lose that income if they went to bankruptcy or any type of restructuring. So pay attention to that. But it could be, if you're in a stable enough company, a really powerful thing for your long-term retirement.
But also make sure when you're making these elections, specifically around deferred comp and pushing bonuses into the future, make sure you have a strategy for your deferral. I have a dear friend who they have been participating, they work for a large company, have been participating in the deferred comp for years. And they were thinking about the current year tax savings. It's wonderful. I put money in, I can defer it into the future. They weren't thinking about the distribution options. They were just saying, I'll just lump sum when I retire, Well, they did this for like 8, 9, 10 years. And as you can imagine, the number got pretty big.
Point.
When they retire, in the year that they retire, they're going to have a huge issue because all that deferred comp money is going to pay out. It's going to blow them into the next tax bracket. And while, yes, that's a wonderful problem to have, it's something that can be avoided through good planning. So make sure, even though it might seem like the payout dates are way, way, way far in the future, make sure you have a plan for it so that you're not setting yourself up for some unintended consequences in the future.
Yeah, I like creating essentially a ladder strategy, usually where you're pushing them out every 5 years so that you get a nice little 5-year bridge. Yep. There's a lot of cool things you can do with these deferred comps. One thing I quickly overlooked was, like we talked about life insurance and disability.
Perfect.
One of the things, disability, remember, you always want to pay that with after-tax money, because if you pay it with after-tax, don't take on. Everybody wants to save the FICA and the Social Security and Medicare, but if you pay it with after-tax, if you ever are disabled, you will get those benefits completely tax-free. So pay attention to that. Also, life insurance through your employer. Life insurance, we think it's very important, to have life insurance to replace your income. Your employer very well could offer you $50,000 free, because that's what the IRS kind of lets you do. Lets the employer fully deduct that if they give it to their employees. But I always remind people, if you're unhealthy, you're going to love your group life insurance if you're a smoker or if you have other type of health concerns, because they're basically looking at the pool of your entire workforce to underwrite you to a degree. Whereas if you're super healthy, if you're out there, like I know we have a whole group back here that's about to start training for a marathon or half marathon. I'm trying to convince them to do half marathon, not full marathon, because of what I've seen people get hurt doing full marathons. But those people, they're gonna be in the shape of their life.
Yep.
It's gonna be better for them to buy life insurance themselves.
That's exactly right.
Because when you're super healthy, you want to be based off of your life. So just understand those unique things. But like I said, if you're somebody who's got some health issues, group health insurance, group life insurance could be a really valuable tool for you.
And then the last thing we want you to be aware of and think of as you're making your open enrollment decisions is a lot of times big companies will offer legal services or advisory services. It's not uncommon for the company that you work for to say, hey, if you need to get your wills done, we have an attorney we've partnered with, we'll cover the cost of that. Or maybe you have a financial advisor that you work with, we will actually provide you a benefit, we'll pay the advisory fees for you. So if you work for a company where that's available, make sure you're not just walking away from free money, because that, just like your employer match, is very much a way to tap into the free money available through your benefits program.